Asset Tokenization for Business and Enterprise.
So the topic is asset tokenization for business and enterprise. I want to welcome our two panelists to the stage. I'll have you both introduce yourself briefly, but I always like to do this with panelists. I want not just who you are, not just what you're working on this moment, but a brief explanation of your origin story of how you got involved with crypto and blockchain and finance. Tell us a little bit something about you. So please.
So I started in crypto a lot of years ago. My first project was in the end of 2016, and since then I worked on dozens of projects. My main expertise in blockchain is growing early stage startups, and this is how I came into my current activity in Kima. Basically, what I'm doing most of my time is working with early stage startup, making sure they have the best way to succeed, meaning having the right product market fit, investment. So this is what I mostly do in life, working with blockchain startups.
And you got into this how? Did you say that?
I was in technology all my life, and at the end of 2016, one of my friends came to me and asked for assistance with the blockchain development, and nobody knew what it meant, so we just started like this.
I like that answer. You didn't know what was going on, you figured you'd do it, and now you're in.
Exactly.
That's the start of every good story in blockchain. Please. Harry.
Gordon, good to see you here again.
Thank you. We crossed paths in Lithuania, missed each other in Barcelona, but now it's our rendezvous, so this is exciting.
You come by the booth later.
Yes.
Yeah, my name's Harry. I'm the managing director and partner, Quantum FinTech Group. We're a discretionary hedge fund. Also, at least for this panel, I'm the co-founder of a protocol called Life. You can stop by the booth later. We're pretty much a consumer DeFi protocol. My story is a little bit more interesting. My background's software engineering. I got into Bitcoin back in 2013. I started with $500. Had to borrow $10,000 from my mom to buy the first Bitcoin mining machine, which was the Avalon ASIC miner. Fortunately, in 2014, some investors, started one of the first hedge funds called Binary, and was fortunate enough to invest in Ethereum early on, EOS, Block One, and more recently Phantom and Tomb in 2022, and then now, so I've been in the space for about almost 10 years now.
Fantastic. Now, I always say, explain it to me like I'm 5 years old. Why do we care about, or what is the utility of tokenizing assets? Why do we care? Why do we need this?
Yeah, so tokenization is one of the most promising aspects of blockchain. Maybe in the last 5 years already. It was named in different ways. It was called securitization. It was called security tokens. However, what we can see in this world, and this is why I believe this should be one of the blockchain next targets, is crypto in itself, by itself, it's a small market relatively in finance. And if crypto and blockchain cannot connect to the real world, if it cannot connect to traditional finance, we are going to stay with a very small market relatively. So basically, what do we mean by tokenization and real-world assets? What we mean is, let's bring the outside world into blockchain, into crypto, and enable this. And this is the general concept. Now, it didn't work out until now, and I think we'll discuss it, in the next minutes, but this is probably one of the most important things in blockchain from market capitalization for sure.
Let me take that one step further. Give me one example. What can I do with a tokenized asset that I can't do with an asset that hasn't been tokenized?
Basically, we're talking about more or less the same thing. If you can take a look at the real world, you can digitize anything, right? So it doesn't matter that when I have money, it's not that I really have it in my bed, right? Or under my pillow. I have it in a bank, in a digital database. However, what blockchain can do, its main capability is to eliminate the middleman. And eliminating the middleman in real-world assets means basically two things. One, it's cheaper. But I think the most important thing is it reduces the settlement time. And reducing settlement time, it's not only money, it's also a risk factor. Because if I need to wait for settlement for a long time, I have a lot of risk. If I can minimize the risk, I'm changing the whole ecosystem of this asset, meaning I can really bring players to the game that, according to their legal capabilities, they cannot handle high risk. So it's extremely important, and this is where I believe the market should go.
Harry, please. So give me the argument for asset tokenization. Why do we care?
You mean for or against? You want
either? Just
okay, either. Okay. So the question is, benefits and I guess kind of the downsides of asset tokenization for businesses and enterprise. So I think let's talk about the first real-world asset token. That's asset token that we're actually almost everybody is actually used here. How many of you here use Tether or USDT? Raise your hands. That's your first real asset-backed token, in my opinion, for business, because people are willing to take a stable coin, like the actual currency dollar-backed asset, because it's very, very liquid. I think the challenge, and I've experienced this myself. I invested in a company, a startup called Blockchain Capital, that's done relatively well. It's up 15x from when I invested in it, and it's one of the very, very first tokenized blockchain securities. So it's a venture fund that's actually a blockchain. But the issue is, because it's a security, you can't trade it. And there's no market for it. And also what happened is, some of our friends that invested in the token, they actually lost the tokens, and the tokens had to be reissued. So just even going through that process, I was like, wow, tokenized securities have a long way to go, because in true crypto nature, when you send something to somebody, once it's lost, it's gone. But with tokenized assets, we have that expectation where we need something to be reissued if the wallet gets lost. I mean, I think probably one of the biggest barriers to adoption is wallet security, and what happens if you lose the token. If I have a boat, like a yacht or a house or a car, and I tokenize that car, but I lose that token that gives me the right to own that car, well, that's a big problem. So I think ownership, one of the biggest challenges is going to be registry of real-world tokenized assets. Now, the benefit, like he was saying, settlement times, faster settlement times, definitely. And you can, with real estate, if you can tokenize real estate and kind of break it up, so you fractionalize things, that's really where I think the benefit is. So there's pros and cons to each, but I think we're quite a long ways off from seeing real assets being tokenized in business and the enterprise. Probably at least another 5 or 6 years away.
Well, let me follow up on a point you're making. Yes, I think everyone's heard horror stories or other stories about losing your private key or losing the wallet or losing the hard drive or paying 10,000 Bitcoin for a pizza, which is terrible. I wonder if in the context of asset tokenization, the model of the wallet concept that we have right now is one-for-one applicable. Maybe it's not. Maybe wallets apply to traditional crypto, but when we're pursuing the goals we're pursuing with asset tokenization, it's more along the lines of either a registry, like you said, or something else. Maybe the issue ran into is that wallets aren't appropriate for securities. Maybe. Any comment?
Yeah, I think, I mean, how many of you use MetaMask here? Raise your hands. Okay. Or have used Binance or any kind of like wallet kind of address. If you have, imagine if you own a car and a part of your car, your actual title and registration was tokenized and it was sent to your MetaMask wallet and you lose it. And then that all of a sudden means, hey, there's no real ownership to the car. So if I'm thinking in real, true, pure crypto terms, that's kind of where tokenization doesn't really work. Does that make sense?
I don't think it works.
I don't think it works, period. Now,
I mean, if someone loses their Bitcoin, the rest of our Bitcoin goes up in value.
yeah, exactly. If you lose a car, you're like,
loses the car, you get a traffic jam.
But the wallet, at the end of the day, it's still a wallet, and I think applying the best technology, as an engineer and technologist myself, I think having the best technology for the job makes the most sense. To this date, I still haven't really seen, even as an investor, like the best, because I get pitched tokenized assets all day long. Like every day I tokenize real estate, tokenize this, tokenize that. But the problem also, the whole point of crypto is the utility value. When you invest in something that's got actual utility, like technology, that's why it was created. Like, for example, like equities. So where I probably see the first big move is very, very liquid assets. Illiquid assets, probably not so much, but I would see stocks being tokenized first, or equities, because they're extremely liquid. I mean, if you look at USDT, it's very, very liquid. So I would say the more liquid the asset, that's probably where you're going to see the tokenization come in first, because crypto is all about liquidity. Once you don't have liquidity for anything, like, doesn't matter kind of like what it's actually worth in the real world, like the value of it actually drops. And the same thing happens with asset tokenization.
Okay, so let me pass it back. Give me your 4 or 5 year perspective on where this is going and your involvement in it. You know, if we were sitting here in 2028, late 2028, what would we be saying about asset tokenization?
Actually, in 2018, when we talked about it, we believed that this day will be already after everything. But now I think we're more or less the same place. If we look from a wallet perspective, I don't think that we have an issue there, because anyway, if you want to be regulated, you need to do KYC and AML, and there are mechanisms to protect the investors. However, if we look from asset perspective, as Harry said, if we're looking from the illiquid into the most liquid, so for sure it's easier to go for the most liquid, like traded shares, but they tried it. It wasn't successful because most of the people will go to their bank or their broker and just do it there. Why should I go and do it on Binance or another place? What I really believe that the place should be one floor before. So you have pre-IPO companies, could be a good idea, and also companies that are issuing bonds in a way that could make sense. And if I can put the difficulties now in the market, I think probably the most problematic thing is not regulation, it's not the wallets. I think it's the liquidity issue. And the liquidity issue is coming from many aspects, but I think from tech perspective, the most important thing is that all the issuance platform and trading platforms are disconnected. So at the end, we say blockchain, but we're basically talking huge amount of networks. And working with huge amount of networks just doesn't make sense. So
and the bridges we have, or the bridges we're developing, or the DEXs that are out there don't solve or start to solve this problem?
I think one of the issues, if we look at the current market is not applicable to a lot of the bridges for many reasons. First, it's too complicated to build bridges with all these platforms. And second, there's a lot of private blockchains there. So you need different mechanism and different thoughts about how to make it. One of the ideas is actually to solve it from wallet perspective, meaning to enable a specific wallet to take care of all the tokens. So after the abstraction, you don't really see on which blockchain it is, but you see the asset that you have. This is one option. But the settlement should be done automatically. And for this, you need something. You need a technology that can see, meaning it can ping, it can verify other blockchains, because in order to make a settlement, you need to understand and be 100% what's going on in every blockchain.
Now, is there, well, I'll give you a little throwback. So 6-7 years ago, I was having a conversation with Pavel Kravchenko from Distributed Lab, and we were talking about tokenization of assets, and we were trying to figure out what was the use of it, what was the point, or what you could add. And something we were talking about at 2 o'clock in the morning with way too much whiskey was maybe once you fractionalize, once you tokenize and fractionalize assets, maybe you can add some intelligence or programmability to those small little fractions in a way that you can't with a legal fractional ownership. And so you could maybe, in a way, kind of create these hyper objects. You know, it's no longer just 1,000th of a real estate deed, but it's something that lets you now do a timeshare, or lets you contribute it to a REIT, or something like that. Do you see anything like that where the tokenization of an object lends new qualities to that thing that weren't there before?
So actually, I'm happy to answer that one. We're actually, so another protocol that we've created actually called L3 Reserve, which is not a stable coin, but a stable asset. we actually presented, I think at the last conference I was in September, SBC Barcelona. And it's an interesting model. I think collateralized lending is probably where you're going to see asset tokenization work, because you're going to, like right now, everything that we see, at least with the stablecoin markets, at least algorithmic, and what we're doing with L3 USD is we're collateralized online against other tokens like USDT, USDC, and DAI. So you can actually play with this on Polygon right now. But we were thinking, okay, how do we do offline? What if somebody wanted to collateralize like their house, or they want to collateralize their watch or a car or something like this? If you essentially put those vehicles into some kind of institutional fund, so it has to be done at kind of the institutional level, and that institutional level tokenizes that and it trades against, let's say, another pool of like stablecoin assets and whatnot. We're experimenting with that to really, really bridge offline assets to becoming online. And that's actually very, very specific to DeFi, what we're doing. I can talk with you about a little bit of offline. It's actually pretty ingenuine what we're looking at. But I think collateralization is probably where you'll see the innovation for asset tokenization for businesses comes first. Because right now the entire market has a huge liquidity issue. Well, if somebody were to offer me a stablecoin or some kind of asset I can collateralize and you can tokenize that actual asset, that's where I think you're going to see the real thing where, okay, as a creditor, if I own that token, I'm entitled to the right to this if I give this person stablecoin or whatever it is. So collateralized lending is where I think that's going to make the most sense, yeah.
Now, when I asked that question, you either smiled or you smirked. I'm not sure which. You're smiling. Well, smiling's good. So what's your reaction to the thesis or the idea that through tokenization, you can not just fractionalize, not just make liquid, but maybe add additional characteristics or features, maybe a software layer on top of just the asset itself? Is there something there?
I built before two security tokens platforms with two different groups. And 2 years ago, we also built a DEX, regulated DEX for securities. We were a great team, a lot of smart people. We couldn't find a killer app. We just couldn't. There wasn't. We thought fractionalizing NFTs, because NFTs was in hype then, and then we thought, okay, if there's an NFT worth huge amount of money, if you make it in fractions, then people can buy it, and because it's in fraction, it's security. It wasn't working. I really don't think that this is where we're heading. I think we should look in two ways. One way is, let's say, call it the private sector, meaning the private tokenization platform join together, do issuance on their own, and then merge it in a tech way, so the liquidity can be joined together, but they still keep themselves, because if you tell them, look, forget about yourself, come together, they lose everything they built. The second thing, I believe, should be coming from the big guys. A lot of banking solutions, let's say, are starting to tokenize their assets. They're doing it for themselves, because for them it's more efficient. They build their platform, they have everything for themselves. If we can connect them, and this blockchain can do pretty well with, like I said before, very low resettlement and very short timing, then I think blockchain will be a very good solution for that.
You both highlighted the necessity and the lack of connectivity being an issue. Just quick yes or no, is that the biggest barrier to widespread and effective tokenization of assets?
I would say it's one of them, but it's like maybe. I'd say probably no. There's other barriers.
Okay, and fine. I can jump in. You led into my next question. How much of a barrier is the legacy legal system?
I don't think it's a big problem. I think it's more a high, because when you take a look deeply, securities are regulated. There's no problem there. We are already doing it.
Is the legal system a barrier to tokenization?
No, because like he was saying, it's the same answer. Tokenization is just a technology method. So regulation doesn't have anything to do with that. But it will affect the liquidity. That's the biggest thing.
Because one thing I wrestled with, and I'll take advantage of the last few seconds, is when I initially looked at this, we were looking at tokenizing real estate. And everyone's like, oh, you're going to own X percent of the entity or the real estate. And the question, at least in the US, was, what does that mean exactly? Are you a 1% tenant in common, which is the traditional definition? Are you a 1% owner of the entity that owns the real estate? You know, if there's not enough cash flow and it has to sell, do you have to contribute more money? It was kind of a question of what does that actually mean when you have a token that is supposed to represent 1%? And I've seen successful and unsuccessful attempts to deal with that. And I'm wondering if you've run into something similar in real estate or any other asset, a legal hurdle that you were able to solve or come up with a better solution.
So I think if you go back to the real estate example, if you were hypothetically to issue somebody, let's say, in a fractional real estate, let's just say, okay, this one property, we're going to fractionalize it. Everybody that owns 1% gets one NFT, right? So you have 100 NFTs for a specific property. People will still want that paper contract in case they lose that NFT, or that NFT is non-transferable. Does that make sense?
Sure. So, but
Yeah.
did you actually really accomplish anything there when you did NFT if you still need the paper contract?
I think you still need the paper contract, or you have to have some kind of central registry that allow you to reissue the NFT. So those things won't really go away. They're kind of a requirement. So you need somebody that controls the entity that controls the central registry that can reissue these NFTs.
And we're getting back to centralization, of course. So we're out of time, but do you want to give a final thought or a headline?
Everything is good. Thanks for coming, guys.
Okay, everything's
Thank
good.
you.
Go home. Harry, any last thought? Or is everything
No, thank you very much, everybody.
fine?
Come visit us at the live booth.